Hi, my name is Anna Hess, your Patton University course instructor. Today we're on Unit 4. This is called Central Banks. Let's start with the introduction. Beyond banks and other institutions where people can keep and access their personal money, most countries have a central bank. The role of the central bank is quite different from that of any commercial bank. Rather than taking deposits, the central bank actually helps to determine how much your deposit is worth. That's to say, central banks help set monetary policy that determines the worth of a country's currency. And rather than giving individual loans, the central bank determines how much interest you will have to pay on that loan. Things like monitoring the money supply, money reserves, and interest rates all fall under the responsibilities of central bank and have large economic implications. In the United States, the Federal Reserve is the central bank, more commonly known as the Fed. This organization sets monetary policies that affect not only the U.S. economy, but also the world because of the wide use and influence of the U.S. dollar. Because of its position, the Fed is one of the most influential central banks in the world. Okay, this is Objective 1. We're starting in Chapter 15, called Central Banks in the World Today. Beginning in the summer of 2007, the most severe and persistent financial crisis since the Great Depression shook intermediaries, markets, and economies around the globe. Some of the largest financial institutions failed, and the market disruptions triggered the world's global succession since World War II. The panic peaked after September 2008, run on Lehman Brothers, the fourth largest U.S. investment bank. As investors around the globe sought to hold only the safest, most liquid assets they can find, investors stopped lending to intermediaries, which stopped lending to each other. As the storm spread, the global financial system bordered on complete collapse for the first time in 75 years. Central banks neither foresaw nor prevented the crisis of 2007 to 2009. Even long after the tempest began, they did not see how menacing it would become. Yet, as the expanding storm continuously poked new holes in the financial boat, policymakers developed new tools to plug the holes. When the financial hurricane finally reached its late 2008 crescendo, the world's leading central banks played a key role in bringing the financial system and the economy back to safe harbor. They acted in unprecedented fashion, on their own as well as with the other central banks and with government finance ministries, to prevent the financial system from capsizing and, over time, to restore financial and economic stability. The Central Bank of the United States is the Federal Reserve, widely known as the Fed for short. The people who work there are responsible for making sure that our financial system functions smoothly so that the average citizen can carry on without worrying about it. During the financial crisis, the Fed fell short of this goal. Nevertheless, it managed in 2008 to prevent the looming collapse of the financial system and to foster a vast improvement of financial conditions in 2009 that helped end the long, deep economic slump. The Euro area consists of 19 countries as of January 2017 that have adopted the euro as their common currency. The Euro area is a subset of the European Union, which consists of 28 countries. The central bank of the Euro area is the European Central Bank, ECB. After working to safeguard the euro during the global crisis of 2007 to 2009, the ECB in 2010 began to face a banking and sovereign debt crisis in several Euro area countries. A flight of capital and deposits out of those countries threatened an end to the euro itself, but extraordinary liquidity provisioned by the ECB purchased time for governments to begin addressing the euro area's vulnerabilities. Strengthened euro area institutions helped limit renewed contagion when, in 2015, Greece teetered on the edge of leaving the euro area. Early caution under similar circumstances on the part of Japan's central bank, the Bank of Japan had provided a negative lesson to the Fed and the ECB. Beginning in the 1900s, the Bank of Japan allowed the country to sink into deflation, following the collapse of huge bubbles in the stock market and real estate market. Over the next 2 decades, Japan's price deflator for gross domestic product sank by nearly 20% from its peak, adding to the real burden of debt. It wasn't until 2014, following a new round of aggressive monetary expansion by the Bank of Japan, that this generation-long deflation was interrupted. These watershed events will leave a lasting imprint on global economies, the financial system, and policy making. Many changes resulting from recent crises are likely to prove permanent rather than temporary. As we saw in chapters 12 and 13, the crisis of 2007 to 2009 has already transformed the structure of the financial industry in the United States, with further change on the horizon. Chapter 14 highlighted the new regulatory environment, especially Basel III, Dodd-Frank, and new approaches to managing systematic risk. In Part 5, we will study the evolving role of central banks. Central banks do not act only during times of crisis. Their work is vital to the day-to-day operation of any modern economy. Today, there is about 185 central banks in the world. Virtually every country has one. Yet, despite the vast power of these institutions and the constant news reports on their activities, most people have only a vague idea of what they are and what they do. This chapter begins to explain the role of central banks in our economic and financial system. It describes the origins of modern central banking and examines the complexities policymakers are now faced in meeting their responsibilities. It also highlights a central question that has become politically controversial following the crisis actions of the Fed, the ECB, and other central banks. Namely, what is the proper relationship between a central bank and the government? The basics. How central banks originated and their role today. The central bank started out as the government's bank and over the years added various other functions. A modern central bank is not only manages the government's finances, but provides an array of services to commercial banks. It is the banker's bank. Let's see how this arrangement came about. The government's bank. Governments have financial needs of their own. Some rulers, like King William of Orange, created the central bank to finance wars. Others, like Napoleon Bonaparte, did in an effort to stabilize their country's economic and financial system. While central banks have been around since the late 1600s, these early examples are really the exception, as central banking is largely a 20th century phenomenon. In 1900, only 18 countries had central banks. Even the U.S. Federal Reserve did not begin operating until 1913. As the importance of government and the financial system grew, the need for a central bank grew along with it. Today it's hard to imagine not having one. As the government's bank, the central bank occupies a privileged position. It has a monopoly on the issuance of currency. The central bank creates money. Historically, a central bank money has been seen as more trustworthy than that issued by kings, queens, or emperors. Rulers have had a tendency to default on their debts, rendering their currencies worthless. By contrast, early central banks kept insufficient reserves to redeem their notes in gold. People must have faith in money if they are to use it, and experience tells us that this type of institutional arrangement creates that faith. Today, the Federal Reserve has the sole legal authority to issue U.S. dollar bills. The ability to print currency means that the central bank can control the availability of money and credit in a country's economy. As we'll see in later chapters, most central banks go about this by adjusting short-term interest rates. This activity is what we will refer to as monetary policy. In today's world, central banks use monetary policy to stabilize economic growth and inflation. An expansionary or accommodative policy through lower interest rates raises both growth and inflation over the short run, while tighter or restrictive policies reduces them. We will discuss the mechanics of monetary policy in more detail in later chapters. Understanding why a country would want to have its own monetary policy is important. At its most basic level, printing paper money is a very profitable business. An $100 bill costs less than 15 cents to print, but it can be exchanged for $100 worth of goods and services. It is logical that government would want to maintain a monopoly on printing paper money and to use the revenue to generate the benefits to the general public. Although when we list the objectives of the central bank later in this chapter, profit maximization will not be one of them. You're going to want to finish this reading on your own. Once you're finished with the reading, you'll want to watch a video called Role of Central Banks in the World Economy, then read an external page called Markets Weighed ECB Rate Moves. And then there's an activity of flashcards to review. This concludes Objective 1. Okay, for Objective 2, we're starting on page 405. Financial system stability. The Federal Reserve was founded to stop the financial panics that plagued the United States during the late 19th and early 20th centuries. It took a while to work out the kinks in the system. As we have seen, the U.S. financial system collapsed again in the early 1930s, as policymakers at the Federal Reserve watched. Between then and 2007, the Fed's track record in preventing or mitigating crises improved substantially. However, recent experience demonstrates that financial and economic catastrophes are not limited to history books. Accordingly, financial system stability is an integral part of every modern central banker's job. It is essential for policymakers to ensure that the markets for stocks, bonds, and the like continue to operate smoothly and efficiently. If people lose faith in financial system, institutions, and markets, they will rush to low-risk alternatives and intermediation will stop. Savers will not lend and borrowers will not be able to borrow. Getting a car loan or a home mortgage becomes impossible, as does selling a bond to maintain or expand a business. When the financial system collapses, economic activities does too. The possibility of a severe disruption in the financial market is a type of systematic risk. Nothing that a single individual does can eliminate it. Central banks must control this risk, making sure that the financial system remains in good working order. The value at risk is not the standard deviation. It is an important measure here. Recall from Chapter 5 that a value at risk measures the risk of the maximum potential loss of a specific intermediary. Newer measures of risk seek to quantify the impact that losses at an individual intermediary could have on the stability of the financial system as a whole. When thinking about financial stability, central bankers want to minimize the risk of a disaster and keep the chance of this maximum loss as small as possible. Their struggles in the crisis of 2007 to 2009 revealed just how difficult it can be to achieve these goals. Interest rate and exchange rate stability. If you ask them, most central bankers will tell you that they do their best to keep interest rates and exchange rates from fluctuating too much. They want to eliminate abrupt changes, but if you press them further, they will tell you that these goals are secondary to those of low inflation, stable growth, and financial stability. The reason for this hierarchy is that interest rate stability and exchange rate stability are means for achieving the ultimate goal of stabilizing the economy. They are not ends unto themselves. It is easy to see why interest rate volatility is a problem. First, most people respond to low interest rates by borrowing and spending more. Individuals take out loans to purchase cars, new appliances, and the like, while corporations issued more bonds and used the proceeds to enlarge their operations. Conversely, when interest rates rise, people borrow and spend less. So by raising expenditure when interest rates are low and reducing expenditure when interest rates are high, interest rate volatility makes output unstable. Second, interest rate volatility means higher risk and a higher risk for premium on long-term bonds. Remember from Chapter 7 that the long-term interest rate is the average of expected future short-term interest rates plus a risk premium that compensates for the volatility of short-term interest rates. Risk makes financial decisions more difficult, lowering productivity and making the economy less efficient. Because central bankers control short-term interest rates, they are in a position to control this risk and stabilize the economy. Stabilizing exchange rates is the last item on the list of central bank objectives. The value of a country's currency affects the cost of imports to domestic consumers and the cost of exports to foreign buyers. When the exchange rate is stable, the dollar price of a car produced in Germany is predictable, making life easier for the foreign automobile manufacturer, the domestic retailer, and the American car buyer. Planning ahead is easy for everyone. Different countries have different priorities. While the Federal Reserve and the European Central Bank may not care much about exchange rate stability, the heads of the central banks are in more trade-oriented countries do. In countries where exports and imports are the central to the structure of the economy, officials might reasonably argue that good overall macroeconomic performance follows from a stable exchange rate. The table 15.2 on the next page summarizes the 5 objectives of a modern central bank. 1. Low, stable inflation. Inflation creates confusion and makes planning difficult. When inflation is high, growth is low. 2. High, stable growth. Stable, predictable growth is higher than unstable, unpredictable growth. 3. Financial system stability. Stable financial markets and institutions are a necessity for an economy to operate efficiently. 4. Stable interest rates. Interest rate validity creates risk for both lenders and borrowers. And 5. Stable exchange rates. Variable exchange rate makes the revenue from foreign sales and the cost of purchasing imported goods hard to predict. Meeting the challenge, creating a successful central bank. The decades prior to the global crisis of 2007 to 2009 were amazing in many ways. The internet and cell phones came into widespread use. Overall, economic conditions improved nearly everywhere, and especially in rapidly growing emerging economies such as those of Brazil, China, and India. Virtually across the globe, inflation was lower and more stable than in the 1980s. In the United States, the inflation rate fell from an average of 5.6% in the 1980s to 2.6% in the first decade of the 21st century and continued to edge lower. Outside the United States, improvements were even more dramatic. In 1980, nearly two-thirds of the countries in the world were experiencing an inflation rate in excess of 10% per year, and nearly 1 in 3 was experiencing negative growth. 30 years later, only one country in 9 had a two-digit inflation rate, while something like 150 countries were growing at rates in an excess of 2% per year. And not only was inflation lower and growth higher for many countries, but both were more stable until a global financial crisis struck. What explains this long period of stability? A prime candidate is that technology sparked a boom just as central banks became better at their jobs. First, monetary policymakers realized that substantial growth had gone up, so they could keep interest rates low without worrying about inflation. Second, central banks were redesigned. It wasn't just that a new central bank was established like the ECB. The structure of existing central banks changed significantly. The Bank of England is more than 3 centuries old. Its building in London has stood for more than 200 years. But its operating charter was completely rewritten in 1998. The same year brought major changes to the organizational structure of the Bank of Japan. Federal Reserve operations have changed too, fostering transparency and accountability. The first public announcement of a move in the federal funds rate was made on February 4, 1994. By 2012, the Federal Reserve had announced that an official inflation goal had begun quarterly disclosures of economic growth and inflation forecasts along with the policy rate projections. You're going to want to finish the rest of this reading on your own. After finishing the reading, there's another external page called Federal Reserve Timeline. Then there's an external page called The Price of Financial Stability, Optimal Crisis that you'll want to read. Lastly, there's an activity of flashcards to help you review. This concludes Objective 2. For Objective 3, we're starting on page 485. We have emphasized on several occasions that the economy relies on the central bank to ensure the stability of the financial system when it is under stress. In Chapter 17, we saw that the Federal Reserve reacted to the terrorist attacks of September 11, 2001, by temporarily flooding the bank system with reserves through discount window loans. Looking back from the perspective of the Fed's response to the crisis of 2007 to 2009, the September 11 episode seems remarkably small, brief, and contained. To sum up, the financial crisis of 2007 to 2009 and the ensuing recession were the most severe and enduring since the Great Depression, while the subsequent economy recovery was the weakest. To study the financial system and the economy, the Fed utilized 3 of its own conventional policy tools: the target range for the federal funds rate, the interest rate on excess reserves, IOER rate, and the rate on discount window loans, to the greatest extent since 1930s, to support economic activity, including lowering the federal funds target rate essentially to 0. Policymakers then proceeded to develop and use a variety of unconventional policy tools, including massive purchases of risky assets and the communication of its intent to keep interest rates low over an extended period. To be able to lend to a wide range of institutions, the Fed, again for the first time since 1930s, invoked its emergency powers to lend to non-bakers. See Chapter 15, Lessons from the Crisis. These unconventional measures added meaningfully to the conventional actions. Against this extraordinary background, Time magazine called the Fed the most important and least understood force shaping the American and global economy. In this chapter, we will see how the Fed uses its policy tools, both conventional and unconventional, to achieve economic stability. We will see that those tools are quite similar to those of other central banks. We will focus on three links: the link between the central bank's balance sheet and its policy tools, between the policy tools and monetary policy objectives, and between monetary policy and the real economy. Let's begin with the operational details that define the tools available for central banks. Then we'll turn to a discussion of the link between those tools and the policymakers' objectives. That discussion will explain why, aside from the periods of financial crisis or very low interest rates, modern monetary policy is equivalent to interest rate policy. We'll examine how policymakers arrive at a target for the federal funds rate. Finally, we'll turn to a discussion of a number of unconventional policy tools that were used in the crisis of 2007 to 2009 and in the post-crisis recovery, and explain how they augment conventional policy. We'll also look briefly at how the Fed began to exit from the unconventional policy accommodation in late 2005 without altering its balance sheet. To keep the discussion manageable, we'll focus on monetary policy in large economies like that of the United States, where trade is a relatively small part of the GDP, and of the euro area, a more open economy, i.e., where trade is somewhat larger part of GDP. Chapter 19 will discuss exchange rates and other issues that are important to central banks in more trade-dependent, more open economies. The Federal Reserve's conventional policy toolbox. Like all central banks, the Federal Reserve can alter the quantity of reserves that depository institutions hold. Reserves are injected into the banking system through an increase in the size of the Fed's balance sheet, either because of a decision by the Fed to buy securities or because of a bank's decision to borrow from the Fed. Besides controlling the quantity of reserves, the central bank can control either the size of the monetary base or the price of its components. We will revisit these control options when discussing the role of interest paid on excess reserves. Like most modern central banks, the Fed usually sets policy by focusing its attention on prices rather than quantities. The price it concentrates on are the interest rate at which banks borrow and lend reserves overnight and the interest rate that the Fed pays on reserves that banks hold at the central bank. Understanding day-to-day monetary policy requires a familiarity with the institutional structure of the central bank and financial markets. What is true in one country may or may not be true somewhere else. Because cataloging the structure and tools of the monetary policy around the world is too big a task, we will begin with the Federal Reserve and the financial markets in the United States. In the next section, we will look at the ECB's operating procedures to see how they differ. The Federal Reserve has four leading conventional policy tools, also known as policy instruments. See Table 18.1. 1. The target federal funds rate range. The interest rate at which banks make overnight loans to each other. 2. The interest rate on excess reserves, IOER rate. The interest rate paid by the Fed on reserves that banks hold in their accounts at the central bank in excess to reserve requirements. 3. The discount rate. The interest rate charged by the Fed on its loans to banks. These loans provide liquidity to banks and are used to stabilize the financial system rather than as a tool to alter day-to-day monetary policy. 4. The reserve requirement. The level of balances a bank is required to hold, either as bulk cash or as a deposit at a Federal Reserve bank. Conventional tools for the Federal Reserve. Before we examine these four tools in detail, it is worth noting that the Fed also has an important supplementary tool for monetary policy, the overnight reverse repo, on-RRP rate. The on-RRP rate is the interest rate paid by the Federal Reserve on funds from the non-bank intermediaries supplied via overnight reverse repurchase, repo agreements. Recall that a repo is a short-term collateralized loan in which a security is exchanged for cash, with the agreement that the party will reverse the transaction on a specific future date. See Chapter 12. The ONRRP rate serves to keep the market federal funds rate close to the IOER rate. As we describe in the appendix of this chapter, the ONRRP rate can be used to set a floor under the market federal funds rate. The target federal funds rate and the interest on excess reserves. Prior to the financial crisis, the target federal funds rate was the Federal Open Market Committee's primary policy instrument. Financial market participants constantly speculated about movements in this rate. FOMC meetings always ended with a decision on the target level, and the statement released after the meeting began with an announcement of that decision. To a large extent, that decision constituted U.S. monetary policy. But because the federal funds rate was and remains the rate at which bank borrows from other financial intermediaries overnight, it is determined in the market, not controlled by the Fed. With this qualification in mind, we distinguish between the large federal fund rate set by the FOMC and the market federal fund rate, at which transactions between banks and their overnight lenders take place. You're going to want to finish this reading on your own. After the reading, there's an external page called FRB, How Does Monetary Policy Influence Inflation and Unemployment, that you'll want to read. Then there's another external page called If You Were Stranded on a Desert Island and Could Only Bring One Economic Plan. And lastly, there's an activity of flashcards to review. This concludes Objective 3. We're going to start Objective 4 on page 500. Inflation targeting. When you focus central bankers' attention on a well-articulated objective, you get better policy. During the 1990s, a number of countries adopted a policy framework called inflation targeting in an effort to improve monetary policy performance. Today, central banks in countries that produce nearly 2/3 of the global GDP operate at de jure or a de facto inflation targeting regime. Countries that embraced inflation targeting achieved both lower inflation and, at least until the financial crisis of 2007 to 2009, more stable real economic growth. Inflation targeting focuses directly on the objective of low and stable inflation. It is a monetary policy strategy that involves public announcement of a numerical inflation target and underscores the central bank's commitment to price stability. When the target is credible, because the central bank routinely acts to achieve it, everyone believes that inflation will be low. Long-term expectations of low inflation act to anchor low long-term interest rates and promote economic growth. So inflation targeting is designed to convince people that monetary policy will deliver low inflation. And if central bankers are resolute, it usually works. To compare inflation targeting with other policy regimes, see Applying the Concept, Alternative Monetary Policy Targets, Inflation Price Level and Nominal GDP on pages 498 to 499. Often, central banks that employ inflation targeting operate under what has been described as a hierarchical mandate, in which price stability comes first and everything else comes second. Australia, Chile, South Africa, and the United Kingdom are among the roughly 24 countries that target inflation in this way. Most observers put ECB in this group as well. The hierarchical approach contrasts with the Fed's dual mandate, in which the goal of price stability together with low long-term interest rates and the goal of a maximum employment are on equal footing. Nevertheless, consistent with inflation targeting, the Fed announced a quantitative inflation objective in January 2012, but set no employment target. To understand how inflation targeting works, let's look at the British example. The Bank of England Act of 1998 granted the Bank of England independence, but also dictated its objective to deliver price stability as defined by the government's inflation target. A 9-member Monetary Policy Committee, MPC, meets monthly to determine short-term interest rates in an effort to meet this objective, which has been defined as annual consumer price inflation of 2%. Because transparency is a crucial part of inflation targeting, the Bank of England releases the interest rate decisions of the MPC along with minutes of its meetings the day after they conclude and publishes quarterly forecasts of inflation in its inflation report. By focusing on a clearly defined and easily observable numerical inflation statistic, and by requiring frequent public communication, inflation targeting increases policymakers' accountability and helps establish their credibility. Not only do central bankers know what they are supposed to do, but everyone else does too. By reducing any incentive that future policymakers might have to re-eng on the commitment to low inflation, this framework of communication and accountability helps overcome the time consistency problem. The result is not just lower and more stable inflation, but usually higher and more stable economic growth. Nevertheless, as we saw in the global crisis of 2007 to 2009, inflation targeting is not sufficient to prevent financial disruptions that undermine economic stability. A guide to central bank interest rates, the Taylor rule. Interest rate setting is about numbers. The FOMC sets a target range for the federal funds rate. To simplify matters, imagine that the center of this range is the target level, say 0 or 2 or 4%. And these policymakers don't merely pick the target, they also choose the day on which to make the changes. How did they do it? The answer is that they have a large staff who distill huge amounts of information into manageable sets of policy recommendations. Committee members digest all information, meet, and reach a decision. We could try to list all of the other factors they consider and explain how each influences the committee's decision, but that would take another book. What we can do is study a simple formula that approximates what the FOMC does, called the Taylor rule, after the economist who created it, Professor John Taylor of Stanford University. It tracks the actual behavior of the target federal funds rate and relates it to the real interest rate of inflation and output. The formula is target Fed funds rate equals natural rate of interest plus current inflation plus 1/2 inflation gap plus 1/2 output gap. The natural rate of interest is the real short-term interest rate that prevails when the economy is using resources normally. Taylor originally used 2%, which is close to the average real short-term rate. The inflation gap is current inflation minus an inflation target, both measured as percentages. The output gap is the percentage deviation of a current output, real GDP, from a potential output. As Chapter 21 discusses in detail, potential output is what the economy is capable of producing when its resources are being used at normal rates. When inflation exceeds the target level, the inflation gap is positive. When current output is above potential output, the output gap is positive. The Taylor rule says that the target federal funds rate should be set equal to the natural state of interest plus the current level of inflation, plus a factor related to the deviations of inflation and output from their target or normal levels. For example, if the natural rate of interest is 2%, inflation is currently 2%, the inflation target is 2%, and real GDP equals its potential level, so there's no output gap. Then the target federal funds rate should be set at 2 plus 2 plus 0 plus 0 equals 4%. This rule functions like a thermostat, tuning the policy interest rate if the economy, measured as inflation and output, is too hot or cold. It makes intuitive sense. When inflation rises above its target level, the response is to raise interest rates. When output falls below the target level, the response is to lower interest rates. If inflation is currently on target there is no output gap, the current GDP equals potential GDP, then the target federal funds rate should be set at natural rate of interest plus target inflation. The Taylor rule has some interesting properties. Consider what happens if inflation rises by 1% point from 2% to 3% and the inflation target is 2%. Assume that everything else remains the same. What happens to the target federal funds rate? The increase in inflation affects two terms in the Taylor rule, current inflation and the inflation gap. Because of the inflation, target doesn't change, but both these terms rise 1 percentage point. The increase in current inflation feeds 1 for 1 into the target federal funds rate, but the increase in the inflation gap is halved. A 1 percentage point increase in the inflation rate raises the target federal funds rate 1.5 percentage point. You're going to want to finish this reading on your own. After finishing the reading, you're going to want to read an external page called Monetary Policy in the Central Bank. Then read an external page called Central Banking's Newest Fad. And then there's an activity of flashcards to review. This concludes Objective 4, and this concludes Unit 4.